Imagine waking up one morning, grabbing your phone, and seeing a screen full of green numbers telling you are suddenly a millionaire. That happened. Real people, teachers, truck drivers, college students, amassed vast fortunes almost overnight. And then, almost as quickly, they watched those accounts drain to zero. This is the story of crypto's golden era. It is a timeline defined by extreme whiplash, an ascent into unimaginable financial euphoria followed by absolute devastation. To understand how so much of this money moved so fast, we have to look at how money normally works. Regular cash, the dollars in your bank account, is controlled by centralized middlemen. Banks and governments dictate how much exists and have the power to freeze your access. Cryptocurrency was designed to bypass those institutions entirely. The goal was to replace the banker with pure math. It runs on a network called the blockchain. Instead of a private bank ledger, it is a public record book shared across millions of computers. If someone tries to cheat, the network checks the copies, sees the math doesn't match, and rejects the change. Bitcoin was the first successful application of this technology. It launched in 2009, coded by an anonymous creator, or group, using the name Satoshi Nakamoto. In its earliest days, it was practically worthless. In 2010, a programmer famously traded 10,000 bitcoins for 2 pizzas. A decade later, those same coins held a value of roughly $600 million. This surge in valuation transformed a fringe mathematical experiment into a globally traded speculative asset. This chart tracks Bitcoin's surge. The value accelerates upward through 2013, spikes in 2017, and rockets to a peak of $69,000 in 2021. The entire crypto market reached $3 trillion, more than France's GDP and Apple and Google combined. Sovereign nations started buying in. El Salvador officially adopted Bitcoin as legal tender, heavily promoting it on the global stage. It bled into everyday life. You could walk into a Wendy's or a local coffee shop and pay for lunch using decentralized digital currency. The sheer volume of cash triggered secondary manias. Digital pictures of cartoon apes, known as NFTs, began selling for upwards of $400,000 apiece. Billions of retail dollars flooding the system created a powerful illusion. For the average investor, the upward trajectory looked completely inevitable. But beneath the massive valuations, severe structural flaws were silently accumulating. Thousands of fake digital tokens suddenly flooded the market. Anonymous creators would convince normal people to invest, then immediately drain the funds and vanish, a scam known as a rug pull. To maintain the hype, projects paid celebrities to manufacture legitimacy. Kim Kardashian promoted a token called Ethereum Max to her 225 million followers. Regulators in Washington finally started circling. The SEC levied massive fines against promoters and began issuing public warnings to retail investors about the extreme risks. When rising interest rates pressured the economy, the crypto market collapsed. This chart tracks the 2022 fallout. In months, major projects like Terra Luna and Celsius imploded, dragging the total market value down from $3 trillion to under $800 billion. The ecosystem originally designed to free people from corrupt banking middlemen had simply replaced them with unregulated, highly volatile shadow banks. The final blow came from 30-year-old billionaire Sam Bankman-Fried. He ran FTX, the second largest crypto exchange, positioning himself as the sensible adult in the room. His company bought Super Bowl commercials and secured the naming rights to the Miami Heat stadium. FTX looked like a permanent fixture of modern finance, but it was a massive, illegal shell game. Bankman-Fried was secretly taking real customer deposits, money belonging to ordinary people, and using it to cover disastrously risky trading bets made by his separate hedge fund. When the market crashed, those bets failed, and $8 billion of customer money vanished. In November 2023, a federal jury convicted him on 7 counts of fraud and conspiracy, leading to a 25-year prison sentence. The FTX implosion not only destroyed billions in wealth, but permanently shattered the myth of the benevolent crypto genius. When you strip away the macroeconomic data and the courtroom drama, what remains is the actual human cost. An average retail investor in 2022 lost about $4,500. A retired teacher in Ohio lost her entire nest egg when the Luna token collapsed. A young man in Texas took out a second mortgage to buy Bitcoin at the top and lost his home. A California nurse locked her emergency fund into the Celsius platform and was frozen out of her own money for 18 months. Retail investors absorbed the brunt of these losses, having entered the market based on a coordinated narrative of guaranteed security, while lacking the hedging tools available to professional firms. While Bitcoin and blockchain technology continue to operate, the specific speculative climate of the 2021 boom has transitioned into an era of increased federal oversight and institutional adoption. We have seen this specific type of mania before. In the 1920s, ordinary Americans borrowed heavily to buy soaring stocks, inflating a bubble that ultimately triggered the Great Depression. In the late 1990s, investors poured billions into internet companies that generated absolutely no profit, leading to the devastating dot-com crash of 2000. The rules of finance always reassert themselves. If an investment sounds too good to be true, it is. Celebrity endorsements are paid advertisements, not financial advice. Real wealth is almost always built slowly, over decades, not overnight. The technology may eventually find a permanent place in the global financial system, but the height of the boom serves as a reminder of the historical patterns that govern every speculative rush.